Hello, and welcome to this video module on debt restructurings. A debt restructuring, sometimes just called a restructuring, is a transaction in which a company alters the terms of its debt obligations. The transactions normally involve a financially distressed business, with the goal of the restructuring being to ease debt restrictions so a business can continue to operate. Sometimes the goal is just to recover as much funds as possible for creditors. A restructuring can take various forms. It could be in court via Chapter 11 bankruptcy, also known as a reorganization where a company emerges and continues on as a going concern. It could also be a Chapter 7 bankruptcy, which is basically just a liquidation, trying to recover funds for creditors. You can also have an out-of-court restructuring, sometimes called a workout. The result of a restructuring can take various forms. You can have a debt for equity swap. For example, bondholders agree to basically become equity holders, usually wiping out the equity holders in the process. You can have altered debt terms. For example, a term loan that was amortizing quarterly or yearly may be pushed out, so it's interest only for a few years to let a company better meet its obligations. You may have new equity raised, sometimes from existing shareholders, called a rights issue. Where a company tells its bondholders or equity holders, hey, we need more money. If you don't put up the money, we're going to dilute your ownership down or change the terms of your obligations. You could also have a distressed asset sale. An advisor may be brought in and the creditors may just decide that they just want to sell the business and recoup whatever money they can. The top restructuring investment banks include Lazard, Blackstone, Rothschild, and Houlihan Lokey. Note that these banks aren't normal household names associated with banking. They are not big lenders, and therefore they don't face the conflict of interest issues faced by household name banks like Bank of America, Citigroup. Investment bankers play a number of key roles in restructurings. Bankers are hired by both sides in restructurings, by the debtor, also known as the company, and by the creditor. And the creditor actually may be a whole bunch of different groups who hire a whole bunch of different banks. There could be all various tranches of debt in the capital structure. So you may have banks or senior lenders hiring an advisor. You may have bondholders hiring an advisor. You may have subordinated debt holders hiring an advisor. You could even have equity holders hiring advisors. Bankers often focus initially on valuing a business, and that involves precise financial modeling, traditional valuation techniques that we've discussed in earlier modules, such as comps, M&A comps, discounted cash flow. But it also often involves other methods, such as valuing intellectual property, valuing assets such as contracts, valuing other physical assets. I mean, the bankruptcy bankers need to get a hold for what a company is worth at a given moment, what it might be worth if it turns around, what it could be liquidated for to pay off creditors. Bankers will often provide expert testimony in bankruptcy court proceedings. Often that testimony focuses on valuations and a business's ability to service debt, whether a business has a good chance of being a going concern. Again, the goal is often to try to figure out for creditors if they'd rather exchange debt for equity and participate in the upside in the future, or if they'd rather just liquidate everything right now and take what they can get in cash. Bankers often lead negotiations between debtors and creditors, especially out of court or in what's called pre-packaged bankruptcy. That's almost like like mediation, where the sides, the creditors and the debtor, agree to terms and then they bring that before a bankruptcy judge for approval. Bankers will also serve as M&A advisors, either on the sell side or the buy side, for the sale of particular assets or the sale of an entire company. These are known as distressed sales, distressed M&A. There are buyers out there, sometimes known as vultures or turnaround specialists, who may want to buy distressed assets, often a good chance to get a price that may be below the previous market value. Obviously, there's a risk that of the business being disrupted by the distress that it's going through, of losing customers, losing employees, but there are investors who specialize in such situations who are happy to take a look. Bankers also assess the viability of a business. That involves either creating or analyzing a business plan. along with financial forecasts. The bankers might say to a company, you can't survive the way you are, you need to trim your costs, we need 10% more on the gross margin, you're going to have to go overseas for products, you may need to cut some employees or facilities. So the bankers really do get very hands-on with the business here, trying to assess whether or not it can continue as a going concern. Basically, there's endless possibilities in restructuring. So restructuring bankers demonstrate financial expertise, financial creativity, and solid negotiating skills. Let's look at an example. A recent example that was in the news is General Motors. Went through Chapter 11 bankruptcy restructuring in 2009. The filing reported assets of $82 billion and liabilities more than double that at $172 billion. So from the get-go, the company was clearly having problems. It was not at all profitable, losing, I think by 2008, about $30 billion a year, had massive pension obligations and other compensation obligations to employees, and just wasn't selling enough product profitably to keep going on its trajectory. The company developed a new business plan where it reduced its break-even sales number from 16 million automobiles down to 10 million. The plan included shuttering brands such as Hummer and Saturn, the sale of assets, they sold the Saab brand, closed manufacturing plants, closed dealerships, and involved employee layoffs. But all of these sacrifices needed to be made to keep the company alive in some form. The bankruptcy included bondholders agreeing to a debt-for-equity swap. So the bondholders gave up their right to be repaid, and they were junior to certain other obligations, but they swapped it for equity, 10% straight up, and the ability actually to earn up to about 25% depending on the performance of the company. The union-based employees agreed to alter terms of their compensation, including health and pension benefits, in exchange for a note payable, preferred stock that paid a dividend, and 20% of the company's stock. So you can see here the theme is people that were owed money basically needed to be convinced, probably by investment bankers, that the best way for them to recover or recoup the money was to forgive a debt obligation, at least in part, and accept equity, accept ownership in the company, accept a stake in the upside of the going concern in exchange for their debt. Now, the government, as we all know, provided a big amount in exchange for a note payable. It put up about $30 billion, and it received a note payable, preferred stock, and it got 60% of the ownership in the business. And this 60% number is something that investment bankers, lawyers, advisors on all sides would have been working on. They would have been valuing the entity, looking at various operating cases going forward, convincing a court, convincing the government that there was a benefit to keeping this company alive and that there was value in it. So the pre-bankruptcy shareholders, if we look back to our original assets and liabilities, they got wiped out completely. And the government in 2010 was able to reap some rewards from the IPO. So General Motors was taken public in this whole transaction, taken private in this whole restructuring, and went public a bit over a year later, towards the end of 2010, the government sold some of its shares. It reduced its stake from a little over 60% to about a third, to 33%, and the government realized proceeds of about $23 billion it got back between debt payments, interest payments, selling its preferred shares, and selling shares in the IPO. Now the government actually, before it put up the $30 billion, put up some more money, so not quite a home run investment, but obviously there were some other motives here for the government in terms of employment and keeping the U.S. auto industry alive. Today, it's a bit of a success story. GM's operating at a profit, $5 billion in 2010 versus a $31 billion loss in 2008. It now has debt of about $26 billion versus more than $100 billion in 2008, and that includes retirement benefits. So this is just an example of how a restructuring might look, the parties involved, and basically the gist of it being, early debt obligations that probably couldn't be met, a company readjusting its business plan, negotiating with stakeholders, and working on an outcome that worked well for as many people as possible.